Hey traders, it's Asim Trading again. So I wanted to do a quick lesson based on some questions that I received, mainly dealing with entries, position sizing, exits, things like that, and I'll just discuss my general framework and approach for that. So just as some starting points, you should have a baseline amount of risk that you're willing to take per trade. So, let's say you have a $10,000 account. Generally, you don't want to risk more than, I would say, 1 or 2% per trade at the most. Even that's kind of pushing it. If you're not a seasoned trader and you don't know what you're doing, like you haven't maintained profitability for a decent length of time, risking 1 or 2%, all it's going to do is like make you blow up really quickly because you're going to lose a lot of money fast. 1% doesn't sound like a lot, but once you string together lots of losing trades, that dynamic changes pretty quick. So let's say for example purposes that we have this $10,000 account and we want to risk no more than 0.5%, so basically 0.5% per trade. So essentially that means you're risking $50 per trade on your $10,000 account. So if you do a full loss on a trade, that means you're going to lose $50, which is equivalent to 0.5% on your full account. So the question is, okay, so now your baseline risk value is $50. This is what you would call R. Like this is your risk per trade. How do you determine the position size? And honestly, it really depends on a lot of different dynamics. So, as an example, we have plug here from a few days ago, and this is actually a trade that I took. So let's say that you back up a few days. This is a cool feature of TC2000 is you can actually back up the bars and look at kind of historically what it looked like before and during and after a breakout. So let's say this has an ADR of 11%. You're looking at the Bollinger Band width here. If you look at the top of that call out box, it's 5%. So you have basically half of an ADR of width from top to bottom of these Bollinger Bands. And let's say you took this trade. Let's say, because you can imagine the bar closed, and I can zoom in a little bit. The bar closed near the lows of this 30-minute bar, but you can imagine at some point in the session it was trading up near the highs here. So for all intents and purposes, let's say it broke the upper Bollinger Band and you happen to get sucked into this trade here. Let's just say that was your entry point. So the question becomes, okay, if you're entering at this point in time, let's say it's 440 for all intents and purposes, how many shares do you buy based on your $50 of risk? So honestly, it really depends on where you want to put your stop. So let's say that you put your stop at the lows of this bar. Let's say it's 420. So if you got in at 440, you're getting out at 420. That's 20 cents of risk on this trade. So essentially, you take your $50 of risk and you divide it by that 20 cents. So you take 50 and you divide it by 20 cents. That means you can buy 250 shares of this stock. So you're going to buy 250 shares times, I think, 440. So, we do our math. So basically, your cost is going to be about $1,100 of your total capital. So out of your $10,000, even though you're only risking 0.5%, you're going to have about 10%, roughly 10% of your account in that one trade. And if you get stopped out, at 420, then you're gonna, you're basically gonna lose that full $50. You're gonna be out $50. So essentially, that's how that would work if you put your stop at the lows of this bar. And like everything with trading, there's trade-offs, and I've talked about this plenty of times. Is the tighter your stop is, the bigger your position size can be. That is absolutely true. But also, the tighter your stop is, the more likely you're going to get stopped out, and you're not going to be in the position when it finally actually moves, which, that's ideally not what you want. You want to be in the position, give it enough room to wiggle around within normal volatility, and not choke it off before it even has a chance to even do what it would normally do. So personally, I actually tend to use the pivot lows or the lower Bollinger Band as my reference point. And yes, that certainly puts things a little further away, and which means your position size is going to be smaller. So let's say you still got it at 440, but now let's say, for all intents and purposes, your stop is now at 415. So if you get in at 440, you get out at 415, you have a 25-cent stop. So instead of, what we had before, you have a 25-cent stop, so now you're dividing that $50 by 25 cents instead. So instead of being able to buy 250 shares, now I'm only able to buy 200 shares. So I'm buying 200 shares times 440. This is what calculators are for, right? I'm a product of the public school system, so I have my calculator out quite often. So instead of $1,100, I'm only able to put $880 into that trade. And if my stop is at 415, which is about 5 cents lower, then I'm going to lose $50 if I get stopped out. So again, these are kind of the trade-offs you have to weigh in your mind, is of the pros and cons of a tighter stop with a bigger position versus a smaller position with a slightly wider stop. In this case, if we kind of track this thing forward, on the very next bar you would have got stopped out, so you're out your $50, and then you're possibly waiting for a re-entry. Whereas if you kind of, again, this is subject to interpretation and debatable or whatever. Everybody focuses on these super tight stops. I think they're kind of counterproductive. I understand the desire to have as large of a position as possible in case that the stock actually moves out, but I also understand that only recognizes that the stock would immediately move out and follow through, and doesn't recognize the fact that you get chopped up a lot and have a lot of losses at the same time. So yeah, you might have a bigger position on the positions that move out, but you also get stopped out quite a lot. So I find my batting average to be decently higher. Like the tighter your stops are, just by function of having tight stops, you're going to naturally have very low batting averages. So my batting average in a decent market will be 50-60%. It's not because I'm like some uber master trader. It's just because my stops are slightly lower outside the noise, and I get stopped out significantly less. So my batting average tends to be a little bit higher. So that's kind of the trade-off. It's like I have a higher batting average, but maybe my position size is slightly smaller, but it's slightly smaller. I would argue that your batting average would be significantly negative because of tight stops, but your overall outcomes won't be significantly hampered by having slightly wider stops. I'm not talking about having the stop like way the hell down here and just 20% away, but like 5 cents lower. Like, for someone to act like that's just crazy talk, it ignores basic math. And my experience is, and you can disagree with me if you want, but having the stop slightly outside of the volatility will increase your batting average, which will overcome the fact that the position size is slightly smaller. It'll help you stay into more trades, and it'll help psychologically for you to execute your plan, because that's another aspect that a lot of folks don't really consider. Is it's psychologically difficult to sit there and take loss after loss after loss, just trying to like find a winner that follows through immediately. If you find yourself having a lot of difficulty with really tight stops because of the frequent stop outs, that's not unusual. That's completely normal. That's kind of a function of having really tight stops, is you're going to get stopped out a lot. You're going to have long runs of stop outs. Whereas if you just slightly stick your stop just slightly outside the volatility and the noise, you're going to stay in a lot more trades. Your batting average is going to be higher. This is a tip I learned from Uncle Dave Landry. And he brought this up in his book, Layman's Guide to Trading Stocks, where he basically covered that same topic of just working with traders and kind of encouraging them to move their stops slightly outside the noise. That was the one thing that kind of helped push them over the hump to profitability. Whereas before they were probably struggling and not really having a good time with their system. So this trade, it continues to go up. I added yesterday on this thing when it broke out again. So again, like, is this comfortable to buy right here and watch this thing like retrace, roughly 5, 6, 7%, and you're in the hole? No, like, it's not comfortable at all. Was it within the bounds of my risk profile and the $50 that I was willing to risk theoretically on this trade? Yeah, absolutely. But that's kind of the part of, like, you have to have patience and you have to let the trade unfold. Everybody's in such a hurry to crank their stops up. And it's like, yeah, at this point, if let's say my initial stop was, let's say it was somewhere in this vicinity here, it moves up and it pivots. And, once I get this pivot, okay, now my stop is here. So it's like, okay, like I'm getting closer and closer to having a break-even stop. And then I have this pink line here is the 10-day moving average. At some point soon, if this thing keeps going up, this 10-day is going to be level with my entry point. And it's like, okay, now I'm going to have essentially a risk-free trade. And I have a 10-day trail that I'm going to use to just ride this thing as far as it goes. And that's the thing, you never know. You never know how far these things will go. And just using something simple like a 10 or 20 period moving average trail, sometimes you can these stocks will run for weeks and months without ever violating those moving averages. It can be kind of crazy sometimes. And you talk to any top trader, that's kind of just a recognition of the fact that some of the trades are going to run for really long periods of time, and those are going to make a significant impact on your portfolio. And you don't know ahead of time which one's going to do that. People try to sit there and guess and figure out and determine, I need to know what the leader is. I want to be in the leaders. The leaders are evident after the fact. They're not evident once, as soon as you enter the trade. The stock has to prove itself over time. So essentially you have to release the trade to the uncertainty of the market. And that's kind of the difficult aspect of trading is the losses are very clear and upfront and right in your face, and you kind of move on with the trade. Whereas the winners, you're kind of releasing them into this unknown right side of the chart. You have no idea what's going to happen. You don't know if the stock's going to keep running. You don't know if it's going to roll over and stop you out. It's something you can't control. And a lot of traders, they just have a lot of difficulty with that concept. But, so this is just an example. If you were to get into plug here, stop here, once this thing starts pivoting and once these moving averages start rolling up, it's going to form additional pivots as it goes into the future. And then you just keep trailing the stop in line with these pivots, and making sure that you're using the 10 period moving averages as a backstop, and that you ride the trade until it stops you out. And so that's another thing that you have to consider is these entry bars, these breakout bars, are not going to be some standard length. So that's another dynamic is you're going to basically have volatility adjusted position sizes, because this bar could be 2 or 3%. This bar could be 11%. The bar that you're trying to get in on might be the same width as the average daily range within that first 5 or 10 minutes of the session. And there's nothing you can do about that. You either have to determine whether that trade still fits your risk reward profile or it doesn't. So once the distance from where you think you're going to get in versus your stop exceeds the ADR, then that's probably a trade you don't want to be in, because the risk reward profile is starting to get kind of out of whack. And that's one of the reasons I look for these very, very tight compression areas, because mainly it's about making sure that I keep my risk reward profile intact. Because, if this has got a 3% range, right now this has in this part here, it has a 3% range, and this is a 11% ADR. So it's like within this sort of really tight range, I'm going to be able to find a 5, 6, 7% stop usually. And even if I get in up here and my stop's down here, that's still only it's like less than 6%. So again, like even if I got top ticked on this thing and like it went all the way down here, that's still only a 5% drawdown on that position, whereas it has an 11% ADR. So you can't just look at like raw percentages without considering the volatility of the stock, what's normal for the stock. Having generic concepts of percentage stop losses and those sort of things, they're not helpful because not every stock is the same. So, we could do additional sort of kind of use cases here. If you scroll back a little bit further, this could be another potential setup. Let's say right here, this is a 6% range from high to low. If you look at the call out box at the top there, it's 6%. Again, we have an 11% ADR stock. We have a 6% sort of range here. And you can see sometimes, even though the range here is 6%, you can see the price action here is not encompassing that entire top to bottom range. So, sometimes you can actually even get tighter risk reward than the Bollinger Band would suggest if the price action. And then again, a lot of times you can determine whether you want to put the stop at the lows of the price action or at the lows of the Bollinger Band width. There's trade-offs to either one. You just kind of have to understand those trade-offs and figure out what you want to do as part of your plan. But sometimes things will gap through the Bollinger Band, and so like this really throws things off, because instead of it breaking out from this point here, pretty close to this price action, it gaps up above it. So this is another example where it's like, okay, let's say you got in at 430. A lot of people will use the lows of the gap, and that's totally fine. But you can see if this is 430 and the lows is 395 or so, I mean, you have a 35-cent stop, so that's even wider than the stop we had before. And there's kind of nothing you can do about that. I mean, like you're kind of subject to what the opening price range does, especially if you trade opening range bars. But again, that's part of your plan. So, if you had 35-cent high to low stop, you just take your $50 of risk and you divide it by the 35 cents. So again, like I'm only able to get 142 shares. And whereas in the other situations, I was able to get 200 or 250. But like, what is your other recourse? Are you going to try to like zoom into the 1 minute and try to get some kind of uber tight stop? Yeah, sure, that's possible, but there's a point where you sit there and you're in the weeds way too far and trying to get these extremely tight stops, and you're basically making something out of nothing when it comes to the price action. I would recommend just kind of keeping your time frame static, and just whatever bars show up, that's kind of what you're dealing with. Because there's also benefits to waiting. Because sometimes, I would say a lot of times, this an opening range bar actually closes negative or it reverses. So just by fact of waiting for the bar to close, sometimes you can avoid a lot of sloppy, choppy trades, and that can also help keep your batting average decently higher while the market is in a funk. Because a lot of times the market will open strong in a poor market, and then it'll reverse and close weak. So that's another thing I would recommend is if the market is poor, I would wait longer before considering getting in or not, because oftentimes this is kind of what will happen in a poor market. It'll open up and it'll suck a bunch of people in, and then it'll reverse. So like you have a lot of volatility near the open. And a lot of traders will end up getting stopped out once or twice or 3 times even by trying to use super tight stops. So that's kind of the danger of choppy markets, is they tend to lure traders in and spit them out, not just once but sometimes multiple times. So again, like you just have to look at the breakout bar and kind of assess based on where this bar is in its position, where am I going to get in and where am I going to get out, and like what is the size that I'm going to take to maintain my risk profile. Because again, this is, when it comes to risk management, this is the most important aspect here, is maintaining this per trade risk. Because if you don't understand the importance of this, then you don't really understand risk management. And even this number is not always static. Let's say it's a really poor market. Maybe you cut that in half and you're doing $25 of risk. Because in a poor market, your concern should be drawdown management, not trying to make a bunch of money. Whereas if the market is slightly better, maybe you bump this up to $75 or $100 per trade. And now you're up at the 1% of your capital sort of area. And this number is going to change as well because let's say you double your account and now you're at $20,000. You're not going to stay at $50 of risk. Now you're going to be, to have that same 0.5% of risk, now you're going to be at $100. So eventually over time these position sizes will get slightly, they'll get bigger and bigger as your account size grows. So that's, when Kulamagi talks about scaling your trading, that's what he's talking about. If you double your account, you should essentially be doubling your position sizes, because in order to keep that 0.5% of risk, or whatever you decide your per trade risk to be, in order to keep that steady and constant, because that's the important part, is keeping that steady, over time your trading size is going to have to go up. And that's difficult because once you start getting a decent amount of money, the this amount here of per trade, it starts to get pretty large, and then sometimes the psychology of that is not as easy as one would imagine. It's one thing to have a couple $100 wiggling around, but when you have tens of thousands of dollars wiggling around, it's sometimes difficult to overcome psychologically. But I mean, this is one way that I would kind of walk the dog on this. You can go to these tight areas, and you can see I haven't come to a tight area where it was the same exact breakout situation. This one was at the low end of the range and it broke out. And again, this is in the first 30 minutes of the session. You have this sort of larger range bar that's just now breaking out through this Bollinger Band width. So as far as my methodology, this is when it would show up in my scan. Like when it breaks this upper Bollinger Band, it's going to be coming in my scan, and it's going to be coming into my purview. So this is what I'm going to walk into when I see this stock. Is like, okay, I'm going to assess, am I going to get in here? Am I going to wait for it to break above this opening range bar? Am I going to put the stop at the low of this bar, or a little bit lower at the lower Bollinger Band? And in this case, like, those differences are going to be kind of minor. Let's say I got in at 360. If I go down here, the lower Bollinger Band's around 330, and then the low of the day, or the low of the bar, is a couple cents higher at 333. So there would be a negligible difference between using the low of the bar versus the low of the Bollinger Band, and the position size would be not significantly different. I mean, there may be a 10% difference in the position size overall. But again, you have to judge the situation that you walk into, on these breakout triggers, and then kind of walk the dog backwards of like, okay, if I enter here and I exit here, if you just look at the distance of that in cents or dollars, if you go to the bottom of this call out box, it actually shows on the left there the amount of cents from top to bottom. So if I go from top to bottom, let's say it's, for example, let's say it's 30 cents. If you look at the bottom there, it's 30 cents. Again, I would go to my calculator, I would take my risk profile amount, and I would divide it by the 30 cents. And that tells you how many shares you buy. And of course, you can't buy, 0.66 shares, so you just round it up. I like to use whole numbers. So in this case, or multiples of 5. So I would maybe put 165 shares, or round it up to 170. Again, the difference is kind of negligible. If you're sitting there nitpicking, quarters of a share or thirds of a share, 2/3 of a share, then I think you're overanalyzing things. Just keep things consistent. Round up where you need to round up slightly, and then just take each trade as they come, and make sure you maintain your risk profile. Because, like I said, at the end of the day, maintaining your per trade risk and scaling up is going to be a significant thing that you need to kind of maintain. And again, like if you're losing money and you're running into a bunch of losing trades, take this number and cut it in half. And if that's not working, cut it in half again. You want to be smaller and smaller and smaller as you're trading worse. When you're trading at your worst, you want to be your smallest. And then, once you start getting a rhythm or the market gets back into a better state, then you bump it back up. Maybe you were down to $25 of risk because you just kind of ran into a series of losses. And that isn't to say you sit there and grind and grind and grind. There's a point in time where your per trade risk should be zero. Like, you should be taking no trades because that's what makes the most sense. Don't sit there and like grind yourself into a bloody pulp just for the sake of taking trades, or like, oh, but I reduced my risk. Okay, great. You're still losing money. There's a point in time where like continuing to trade just doesn't make any damn sense. So do what makes sense. If it makes sense to reduce your risk, then reduce it. If it makes sense to stop trading for a period of time, then stop trading for a period of time. Maybe you drop it all the way down to, $10 of risk, and you stay there for a little while. I would recommend traders that if you don't have a string of consistent success, then you shouldn't be taking 0.5% or 1% or 2%. I mean, that's way too much risk, and you're just basically going to blow a hole in your account. Take as little risk as possible to kind of build skill and learn how to trade, learn how to understand setup dynamics, and where to enter, where to exit, how to manage your positions. Once you see some consistent success with that, then slowly ramp this number up over time. And then as you build confidence and you build success and you kind of get into that consistent success or outperformance phase, then you're basically scaling this up as your account grows. So this number will get higher. The share values that you're buying will get bigger. But your stops are going to, be consistently as part of your methodology. Those aren't going to change. Where you set your stops, how you enter your trades, those are not going to change too much until you get into like really, really, really big positions in account sizes. Because there is going to be a point, and if you study Coulimagy, you'll see this very clearly, where over time he had to change some of his tactics because trying to get 1,000 shares is completely different than trying to get 100,000 shares. You start introducing slippage, and a lot of stocks aren't liquid enough to handle that share size, all at one time. So you either have to scale into positions. Let's say you take that 100,000 and you cut it, like you get in 50,000 first, and then 25, and then 25 to get your 100. Coulimagy, he was like, I want to trade stocks that are liquid enough to take the entire order, as soon as I click it. And that's one approach, and he was very successful with that. Other traders might be like, okay, like I need to take that share size and break it into pieces. That way the stock can handle that much, share demand without disrupting the price too much. And the same thing on the downside. You can kind of scale out of trades as well. So that way you're not trying to sell the entire lot all at one point. There's trade-offs with everything in trading. You just have to understand that. As you grow as a trader, you're going to understand these trade-offs more intimately, because there's no black and white answers. Everybody wants black and white answers. They want simple, clean, easy, but that ignores the fact that trading is not simple. It's not, well defined in some ways. There's a lot of ambiguity. There's a lot of nuance that has to be factored in, especially when it comes to position sizes. If you're using a standard risk amount, and the volatility of your entry to exit is not the exact same amount, then there's going to be a volatility in your position sizes. It can't be any other way. Unless you're taking a static like 4% or 6% or 8% stop loss, which is, guys like O'Neill recommended, some sort of 8% stop loss. That would give you more consistent sizes because you're taking a very consistent stop loss. But in this case, your stop loss from your entry point is not going to be consistent because it's based on the size of the bar relative to where your stop's going to be, which is not going to be consistent on just about any trade. So it's just the way that you have to kind of understand. There's not going to be some simple, clean answer. It really depends. And I know that's an annoying answer, but there's a lot of nuance in trading. Again, find these tight areas where you can get a very decent area where you can get some sort of fraction of the ADR, whether it's a third or a half or 3/4. Once this width here, or at least the volatility of the stock, is greater than what the ADR is, then it's not tight enough. Give it more time or pass on it. That way, as you're looking through these setups, you can find these points in time where you have this nice tight price action, and it'll offer you the ability to get, you know, it'll offer you the ability to get a good risk reward profile without having to be super hyperactive. Like I said, I got in right here. My stop was down here, and that's still a little bit greater than half of the ADR for the stock. So it's like I was perfectly okay with that. I didn't have to sit there and be like, oh, I need to get at the low of the bar because I want to get the biggest position size. Like, if you want to do that, great. My experience is you're not going to have an easy time with that, and you're probably not going to make a lot of progress. Most traders can't handle really tight stops, and that's just my experience. Maybe your experience is different. We can agree to disagree, I guess. Anyway, so I just wanted to do a quick video on entries, exits, position sizing, and how these sort of dynamics work with some sort of risk amount per your capital. Again, scale this to your size of capital. If you have 100,000 or 500,000 or a million, it's going to be the same concept. You're still going to take 1%, half a percent, a quarter of a percent of that total, and that's going to be your per trade risk. And then as you decide where you're entering and where you're exiting, that'll determine your position size, and you just kind of work your way from there. So I hope you found this to be informative. Let me know if you have any questions, and I'll talk to you guys soon.